Do time preferences explain low health insurance take-up? Low insurance take-up in low-income population isn't easily explained by the standard single-period expected utility model of insurance that overlooks the relevance of time preference when liquidity is constrained. We designed field survey instruments to elicit quasi-hyperbolic time preferences as well as prospect theory risk preferences and used them to examine whether time preferences explain health insurance behavior of low-income Filipinos. Consistent with theory, those with stronger parameterized time preference are less likely to insure, and the partial association is most pronounced at low wealth where liquidity is most likely to be constrained. Among those with better understanding of insurance, lower take-up is also associated with present bias. We do not find that insurance is significantly associated with risk preferences. Low take-up of insurance against substantial risks related to healthcare and agriculture in developing countries is difficult to explain with the standard single-period expected utility or EU model of insurance. That may be because that model affords no role to time preference, despite insurance often requiring upfront payment of a premium to secure entitlement to compensation for a future loss. This paper examined whether time preference can partly explain low insurance take-up. Evidence that the timing of premium payment influences demand for insurance in low-income settings is consistent with the time dimension of insurance acquiring importance when liquidity is constrained. Both discounting of future compensation when credit cannot be used to pay a premium upfront and present bias may reduce demand. However, the explanation for low insurance take-up doesn't necessarily lie only in time preference. Compared with EU maximization, a more descriptively accurate model of decision under risk may provide greater insight into why so many low-income individuals do not insure. A prospect theory or PT model of insurance in which the premium is perceived as a loss predicts that convex utility over losses will drive demand down. Any motivation to insure would then have to come from the distorted transformation of loss probabilities into decision weights. To assess empirical support for this explanation of low insurance take-up, we elicit quasi-hyperbolic time preferences and PT risk preferences in a nationwide survey of low-income individuals in the Philippines and examine whether these preferences are associated with the decision to voluntarily insure medical expenses rather than remain uninsured. As far as we know, no previous study has elicited constant discounting, present bias, utility curvature, and probability weighting in a general population survey and estimated association between insurance and this fourth dimension of preferences. To motivate the empirical analysis, we obtain prediction from a simple model of the decision whether or not to enroll in health insurance. A contract that stipulates a minimum period between payment of a premium and entitlement to make a claim leaves scope for time preference to impinge on the decision to insure if credit cannot be used to smooth the cost of the premium across period. We show that this intuition is correct irrespective of whether the time dimension of the decision is embedded in an EU model of insurance or a PT model. The insurance probability is predicted to decrease with stronger time preference when there is a binding liquidity constraint. Constrained liquidity is likely to be common in the Filipino population we study. Consistent with theory, there is evidence that constrained liquidity is associated with lower demand for insurance. Poorer households are less likely to insure, take-up respond positively to cash handout given immediately before insurance is over, and the opportunity to delay payment of a premium to harvest time raises enrollment substantially. Constant discounting isn't necessarily the best description of the time dimension of economic behavior. We show that present bias compound the negative effect of time preference on the demand for insurance unless there is an instrument available to commit to the purchase of insurance. Consistent with the prediction of lower insurance likelihood with stronger time preference when liquidity is constrained, our empirical analysis reveals that individuals with smaller discount factors, which are derived from a particular utility specification, are less likely to purchase health insurance. This relationship is strongest among the least wealthy, who are most likely to be liquidity constrained. In the full sample, insurance take-up isn't related to present bias. However, when we restrict attention to respondents who display some understanding of how health insurance operates and what it covers, there is clear evidence that the more present bias are less likely to insure. Our finding of a negative association between health insurance and discounting is consistent with evidence that an option to delay payment of the premium raises the take-up of agricultural insurance. Consistent with the theory that identifies illiquidity as the mechanism through which the time dimension of insurance acquires relevance, and with our finding that the insurance discounting association is stronger at lower wealth, Casabury and Willis 2018 find that the effect of delayed payment is stronger among poorer and liquidity-constrained farmers. They also demonstrate that an opportunity to pre-commit can raise take-up, which suggests that present bias partly explain the large effect of delayed payment. Unlike these experiment-based studies, this paper doesn't deliver evidence of the causal effect of an intervention from which preferences can be inferred subject to the validity of assumption about the mechanism. Rather, we directly elicit preferences in a nationwide survey and examine their association with insurance behavior. We do not evidence of consistent and statistically significant association between insurance and risk preferences. A point estimate indicates that in the sample, greater risk-seeking convex utility of losses is associated with a higher probability of insurance, and this association of is significant when the sample is restricted to respondents who show better understanding of the concept and content of insurance. While inconsistent with theory, the direction of this association is consistent with evidence based on preferences elicited from Holt and Lowry 2002 lotteries over gains. The insurance demand is weak among predominantly risk-averse individuals, and that demand is decreasing with increasing risk aversion. It may be that insurance is viewed as a risky prospect by many with little experience of it. Besides the finding that low take-up of health insurance in the Philippines is associated with time preference and to a lesser extent present bias, the paper introduced a new instrument that makes it feasible to elicit four dimensions of preferences in a field survey of the general population. In developing country setting, even standard preferences are usually elicited from samples of students, farmers, or households in small communities. Thank you.